Well, the Fed has just done the unthinkable. Despite numerous multi-billion-dollar banks collapsing to the ground in the past couple of weeks and calls of desperation for the Fed to halt rate hikes or to even cut them, they have decided to ignore all of it and proceed with yet another interest rate hike, this time by 25 basis points. This is the 9th consecutive interest rate hike and now brings the federal fund rate to 5%, which is the highest it has been since 2007, and we all know what happened shortly after that. Many people believe that the events that have played out recently around the banking sector would break the Fed and force them to either pause the interest rate hikes or even cut them. This, however, has not happened, and many economists and large financial institutions believe it could have catastrophic potential consequences on the US economy, as well as inflicting further damage to the housing market. The first thing to consider when it comes to the housing market is what this rate hike does to housing affordability, putting it in an even worse position than it was before. And this is for a number of different reasons, the most obvious of which is what it does to the mortgage rate, as this recent rate hike is likely to drive the mortgage rate even higher than where it is right now. Now, at the moment, the average 30-year fixed-rate mortgage is 6.42%, which is already at historically high levels relative to recent history, and you'd have to go back to the absolute peak of 2008 to find the last time that it was this high. And this new rate hike means that it's only going to climb higher from here, pushing back into the 7% zone again, which is where it got to for a very brief period at the end of 2022. Now, another consequence of this new rate hike is what it will do to the job market, which on the whole is very concerning. When looking back at historic data, there has always been a correlation between the interest rate and the unemployment rate. When the interest rate rises, so does the unemployment rate, but lagging behind by a couple of years. Therefore, yet another interest rate hike just adds to the likely damage that will be inflicted on the job market in the coming years, increasing the peak that we can expect to see unemployment rise to. As of today, the unemployment rate is near historically low levels. However, we have already started to see a reversal in this metric and have recently seen a large wave of layoffs take place across the economy. This has been particularly present in the tech sector, including pretty much all of the big tech companies. However, it has spread to numerous other sectors as well. Just last week, we saw the likes of Amazon and Meta lay off another wave of employees, and these layoffs have been going on for months now, with no sign of them slowing down or stopping anytime soon, and if anything, they're quite likely to speed up. Now, obviously, if we do see the correlation between interest rates and the unemployment rate continue to play out just like it has done for the entirety of history, then it's not going to happen immediately, and it will most likely take a couple of years for the unemployment to catch up with the interest rate. However, the dominoes have clearly started to fall already, and a rising unemployment rate alongside a declining average income does harm another key pillar of the housing affordability, which is household income, ultimately harming the housing market. Now, if more people are unemployed and the average household income is lower, then this will lead to more housing foreclosures and more people moving in with family or friends rather than owning their own home. And also we're going to see more people resorting to renting instead of owning their own home, all of which adds to the housing supply. At the same time, due to a reduced buying power across the United States, as unemployment rises, we are likely to see demand for housing fall off as well, as fewer people can actually afford to buy a home. So when we look at this housing affordability index, we can see that we are already extremely low on the index, which means we're either going to revert back to a more historic normal, or we're going to keep plunging into the depths of the lows. We know that mortgage rates are likely to rise and stay elevated, and we also know that the unemployment rate is likely to keep rising, which reduces the average household income and increases housing foreclosures. So pretty much the only way that this housing affordability index can correct in the short to medium term is if we see a major correction in the housing market, where we see a sustained fall in average home prices over a period of time. Now, the payment to income ratio is a similar metric that shows unaffordability in a slightly different way, but as you can see by this chart, it does take a significantly higher percentage of someone's income to pay the monthly mortgage payments on an average price home compared to any year in recent history. Something really does have to give, and it's not going to be mortgage rates crashing or average income rising all of a sudden. It has to be home prices that fall if we are to see these affordability metrics correct back down towards the normal. Now, looking at the Case-Shiller Housing Market Index, we can see that nationally home prices are not down by too much, with this index showing a decline of just 2.7% so far. However, if we look at things on a regional level, there are some areas of the US that are painting a very different picture to what it is showing at the national level. Now this chart here shows the regions of the US that have suffered from the worst average home price declines compared to their peak. And as you can see, there are some very high numbers here, much higher than what we can see at a national level, with Pittsburgh suffering from the worst drawdown, being down 23.1%, Detroit being down 18%, and Austin being down 15.4%. And it's also worth mentioning that all of these regions in this chart are from the top 30 regions according to Realtor.com, where this data has been taken from. The truth is that many smaller and more rural areas of the US, many of which were situated on the East Coast, did not experience home price appreciation to anywhere near the degree of various red-hot locations that became very trendy to move to during the pandemic, like Las Vegas, Austin, and also many areas within California. This is why a lot of people don't believe that we're in a housing market crash, because they are too fixated on the national average numbers. It's only when you start to look at the regional housing markets separately that you do start to see that there are some pretty severe corrections already underway. Now, we have also recently seen some big financial institutions come out with a bearish outlook on the housing market, starting off with KPMG, who believe that there are multiple reasons why the housing market will continue to fall as much as 10% in the year of 2023. Now, KPMG cites that the high interest rate and mortgage rates, combined with home prices that are still largely elevated compared to a few years ago, are the main driving factors behind a housing market decline this year. Now, like I mentioned earlier, KPMG also agree that the housing affordability is the lowest it has been since the mid-2000s and lower than any period during the global financial crisis. They also mentioned that mortgage purchase applications are down by over 40% from a year ago in February, and home buyer attitudes in general are deteriorating, with only 17% of home buyers saying that it is a good time to buy in January, which is over 10% lower than a year prior. This has also led to cancellations surging, and some people are even walking away from large down payments in order to avoid a spike in rates, turning what was a multi-year backlog of newly built homes into a complete glut of homes. In saying this though, inventories are still quite low historically, but KPMG do believe that they are likely to rise again in the spring, and most builders are already offering price cuts or other incentives to pull buyers in. They also mentioned the regional disparity in their report and believe that the Midwest is forecast to see flat to modest price growth throughout 2023, as most markets never really took off that much in the first place. Places like Omaha, Cleveland, and even Chicago, which is a bit more expensive than their neighbours, are some cities that remain quite attractive to buyers and are significantly more affordable than many other areas of the US. On the other hand, the West is experiencing the largest price declines, especially in areas like San Francisco, San Diego, Salt Lake City, and Seattle, who are all seeing double-digit declines as a result of a reversal of the pandemic-era migration, as well as being impacted by the tech layoffs. They do believe that the Northeast will experience some cooling of prices due to net migration away from this region, but on the other hand, the South remains high in demand, and places like Atlanta, Charlotte, and Tampa are still posting home price gains of over 10%. Now, there were a couple more giants in the financial world that have come out with bearish statements recently about the real estate market, particularly commercial real estate, including JP Morgan and also Bank of America. Now, the chief executive of JP Morgan's asset management department, George Gatch, has said, "Commercial real estate is an area of concern. We have high interest rates for property developers. How does that impact the real estate market and lenders in that space?" And according to Bank of America, almost a third of fund managers highlighted a systemic credit event as being the biggest risk to the markets, and that a credit crisis could create damaging shockwaves across the global financial system. Bank of America also did say that investors in their monthly fund manager survey were more bearish on the real estate market than they have been since October 2020, having taken cautious positions on the asset class since September of last year. So with affordability at an all-time low, it's certainly not looking great for the housing market. However, on the other hand, there are a couple of key things to look out for that could really help the housing market this year, and I do cover this in more detail in my latest video, which you can check out on the screen right now. Aside from that, please leave a like if you enjoyed the video, subscribe if you want to see more, and thanks a lot for watching.